Most people remember exactly where they were when they missed the biggest wealth event of the last decade. Maybe you heard about ChatGPT. Maybe you even tried it. You typed a few questions, laughed at how smart it seemed, closed the tab, and went back to your life. Meanwhile, the people who acted instead of just watching, Nvidia at $30 turned into $130. Microsoft added $1 trillion to its valuation. Fortunes were built in months that took previous generations decades to accumulate. You didn't miss a stock tip, you missed a pattern. And right now today, in 2026, that exact same pattern is repeating itself. Except this time, most people aren't even paying attention yet, which means the window is still open. But it's closing faster than most people realize. The CEO who said something nobody heard. Jensen Huang runs Nvidia, the company that powers most of the world's AI infrastructure. When he speaks, Wall Street listens. When he warned about AI's rise, the smart money moved. So when he recently said, the ChatGPT moment for general robotics is just around the corner, not in 10 years, not in 5 years, but right now you'd expect that to make headlines everywhere. It barely registered. Most people scrolled past it, rolled their eyes, thought, sure, robots. We've been hearing about robots for years. That skepticism, that's your opportunity. Here's what's been quietly happening while the mainstream media covered other things. In 2020, Waymo was running a few thousand driverless rides per week. Impressive as a demo, irrelevant as a business. By the end of 2025, 450,000 paid rides every single week. Over 1 million rides per month. Nearly 2,500 robotaxis operating across multiple cities. A valuation north of $125 billion. They want to hit 1 million rides per week by end of 2026 while expanding into London and Tokyo. This isn't a startup with a PowerPoint deck and a dream. This is a commercial operation scaling at a speed that should make every investor sit up straight. Amazon tells an even more disturbing story, disturbing because of how fast it happened. In 2019, Amazon had 200,000 robots in their warehouses. Impressive, right? Then in July 2025, they deployed their 1 millionth robot. A 5-fold increase in 6 years. Their robot population now rivals their human workforce of 1.5 million people. Their newest fulfillment center in Louisiana runs with 10 times more robots than traditional facilities and needs half the human workers to process the same volume. They plan to replicate that design across 40 facilities by 2027, generating over $12 billion in savings from automation in just 2 years. This isn't science fiction. This is happening inside the warehouses that ship your packages, the explosive catalyst nobody's talking about. Every major wealth wave in history has had a trigger, a moment when government policy, technology, and capital aligned, and the acceleration became unstoppable. For robotics, that moment arrived on July 4th, 2025. Buried inside a massive piece of legislation, the One Big Beautiful Bill Act, were 3 quiet provisions that have already started redirecting billions of dollars in corporate spending. The most powerful, 100% bonus depreciation on equipment purchases, restored through at least 2029. Here's why that matters in plain language. A $200,000 robotics system that previously had to be written off over 5 years can now be fully expensed in year 1. Before this bill, bonus depreciation was shrinking down to 40% in 2025, on track to disappear entirely by 2027. The math that used to take 5 years to justify, it now pencils out in 12 months. For manufacturing companies operating on thin margins, that's not an incentive. That's a transformation. Robotics just became one of the single best capital investments American manufacturers can make, not someday, but right now in this tax year. When the economics of adoption flip this dramatically, one thing always follows. Capital flows in that direction at scale, and when capital floods a sector, asset prices follow. The threat that's actually accelerating everything. Here's the uncomfortable truth that's driving Washington to move with unusual urgency. China already won round one. Their government has been treating robotics as a strategic national priority for over a decade. The results are staggering. China now has over 2 million industrial robots working in factories, more than half of the entire global installed base, 4 times as many as the United States. In 2024 alone, China installed 295,000 new industrial robots. The US installed about 34,000. China's robot stock doubled in just 3 years. For the first time in history, Chinese domestic manufacturers outsold foreign competitors in their own market, capturing 57% market share, up from just 28% a decade ago. On humanoid robots, specifically the category that could represent the next massive wave, China's lead is even more pronounced. According to Morgan Stanley, China has filed 5 times more humanoid robot patents than the US over the past 5 years. An estimated 8, 7, 90% of the roughly 13,000 humanoid robots shipped globally in 2025 came from Chinese manufacturers. This isn't a gap, it's a chasm. And it explains why the federal government is mobilizing with an urgency not seen since the space race. Commerce Secretary Howard Lutnick has been meeting directly with Boston Dynamics, Tesla, and Apptronik. An executive order on robotics with a comprehensive national strategy is in preparation. The Department of Transportation has established a dedicated robotics working group. Billions in federal dollars are being committed to autonomous military equipment, manufacturing automation, and R&D designed to close the gap. This is no longer just an investment story. It's a geopolitical race with money behind it. So how do you position yourself without needing a PhD in robotics or a hedge fund's research team? The most straightforward approach: broad robotics ETFs. Funds like bots hold 50-plus stocks spanning robotics, automation, and autonomous vehicles, giving you sector exposure without betting the house on a single company. Robo takes an even wider view, covering roughly 77 companies across the full automation spectrum, including smaller players with explosive upside potential. If you believe military applications will attract the most federal dollars first, and the evidence strongly suggests they will defense-focused ETFs capture the autonomous weapons, drones, and unmanned systems spending that the administration has explicitly prioritized. Military tech has a long history of funding breakthroughs that later reshape commercial markets. For the manufacturing angle, the direct beneficiary of those new tax incentives, industrial sector ETFs, provide exposure to the companies building automation equipment and the manufacturers deploying it. Then there's the infrastructure layer. This is the play that removes the need to predict which robotics company wins the commercial race. Every robot needs chips. Every autonomous system generates data that needs processing. Every physical AI application demands computational power. Semiconductors, data centers, AI infrastructure, these are the pipes that every robot drinks from, regardless of which company ultimately builds the best robot. The pattern is repeating. The question is whether you see it. The people who built fortunes from the AI wave didn't have perfect information. They didn't know ChatGPT would become the fastest-growing consumer application in history. They didn't map out exactly how enterprise AI would reshape every industry. They simply recognized that something massive was happening early enough before it was obvious, and they let time and compounding do the rest. Right now, robotics feels to most people the way AI felt in early 2023. Interesting, but not urgent. Transformative in theory, but probably still years away in practice. Something to watch, not something to act on. That perception gap between where the technology actually is and where most people think it is precisely where investment opportunity lives. The numbers are already moving fast. Waymo, 10,000 to 450,000 weekly rides in 30 months. Amazon, 200,000 to 1 million robots in 6 years. China, robot stock doubled in 3 years. US tax incentives, the most favorable for automation in decades. Global funding, hitting consecutive record highs. The risk nobody wants to say out loud. Let's be honest, because real analysis demands it. Many robotics companies burning through capital right now will fail. The technology is expensive, deployment is messy, and integration into real-world workflows is harder than demo videos make it look. Government policy can shift. China's lead could intensify in ways that benefit Chinese companies at American expense. The political tension between automation and job creation is real and could generate backlash. And there's this. Even when you're right about a long-term trend, markets can stay irrational longer than your patience lasts. This isn't a guaranteed outcome. It's a probability play on a large directional shift with timing that nobody can predict with precision. 5 years from now, when robots are operating at scale in factories, warehouses, delivery networks, and maybe your neighborhood, will you be the person who saw the pattern repeating and acted? Or will you be the person who watched it unfold from the sidelines, the way so many watched the AI boom, thinking it was interesting but not urgent, right up until it became obvious to everyone, which is when it was already too late? The people actually building this technology, the CEOs, the engineers, the investors who have staked their careers on it, they're saying the inflection point isn't coming someday. It's happening right now. The only question left is whether you'll recognize it in time.